Hello, everyone. Welcome back to another economic and market valuation update. I'm your host, Mayur Thaker. I am the Senior Relationship Manager and an analyst here at Zacks Investment Research. And today we're going to be talking about two topics that are on the top of the minds of every investor out there. Number one is inflation, and the other is recession. And it's kind of interesting that we're talking about both at the same time because they are basically on opposite ends of the spectrum. It's very rare to have both occur at the same time. So let's talk about both of these items here in some of these key updates and updates to the charts that we have been looking at in prior webinars. So let's go ahead and get started. So first question is has inflation peaked? And let's take a look at some of the charts that we looked at last time. If you recall, we last spoke about this back in January of this year, 2022. And this is what the chart that I showed back then looked like, which is overlaying the CPI index year-over-year growth with the ISM backlog index. And this is something that I've found to be remarkable. I don't really see this, mentioned very often in financial media. But I wanted to bring this to your attention because I think it's a worthy correlation to take note of. And here you can see it's a lot of ups and downs here, but essentially what this is telling you is that the inflation index, right, the CPI, the headline number that we see, has a very, very strong correlation, positive correlation with the ISM backlog index. And that makes sense intuitively, right? Because as backlog increases, what that means is producers are unable to keep up with demand. Producers are simply unable to keep up with orders that are coming in. And that's what happens when backlog starts to rise because of that. So when production is unable to keep up with demand, backlog rises. And therefore, when backlog rises, prices are forced to go up because manufacturers really have to prioritize orders, and therefore, they, tend to raise prices when they are unable to keep up with demand. And so we saw that, the backlog index really soared in the post 2020 COVID drop initially. And with that came inflation, right? So we saw both the backlog index hit essentially 25 plus year highs, and the CPI index kind of, coincided with that. Interestingly, though, I think that the backlog does give you a slight heads up on that. You can see that it does move a few months in advance of the CPI. So I do believe that the backlog index is a forward-looking indicator, slightly forward-looking, not by a lot, but by maybe 1 to 3 months of the CPI index. So this is what the number looked like in January. And now let's look at an update of that. You can see that now the number has come down quite substantially. You can see the backlog has really eased from, in January it was a reading of 62.8. Now it's down to 53.2. So I think that this is a very strong indication that we are about to see the headline CPI number come down. So, again, this is a pretty good forward-looking indicator overall for the headline inflation number. So I do think that I don't know if this is necessarily the top of the CPI, but I do think that this will be a time where the CPI starts to decline. And we can see that, by the way, the reason for why this backlog index started to decline is not because of a drop in demand, right? Because that's one way that backlog can come down, is if orders simply start to come down, if order flow slows down. But that hasn't actually happened yet. We can actually see that factory orders are right along trend growth overall. So this backlog coming down with demand staying strong is, to me, an indication that the supply chain concerns that have really plagued us for the last year and a half are finally starting to resolve itself. And so this is a very, very encouraging development to see here. So I do think that because of this decline in the ISM backlog index, I do think that the CPI is about to start to roll over here. So we will see if that happens. But I have very, very strong, confidence that will, indeed occur. So another thing that's also interesting to note is that while the headline CPI has been hitting highs, and that's what gets all the attention and all the press time, We saw the most recent reading in May, at the end of May, was 8.6% year over year. That's again, a 40+ year high in terms of year over year growth of the CPI index. But the underlying component of that, which is core CPI, which basically excludes food and energy, that has actually been declining since March. So what this is telling me is that the majority of the increases in prices since March has been in the food and energy area. But in core CPI, that number has basically been topping out and has been coming down for several months now. So I think that the core CPI is a leading indicator right now, at least, for the headline number. So again, as long as food and energy commodities prices start to come down, the CPI number should start to come down. And that's exactly what's been happening year to date, or over the past few weeks here that we've seen. Food and energy commodities prices, especially agricultural commodities like wheat and soybeans and oats, they've been coming down quite rapidly. And in the energy side, the price of WTI crude has come down quite a bit as well. We're now well below $100 a barrel, hit much higher levels than that just a few weeks ago. So all this is kind of leading me to believe that the CPI should start to come down. And we will see how much it comes down and whether that 8.6% was the all-time high mark that, will just remain in the history books. But as I was saying here, demand actually still continues to remain strong. We see that factory orders year over year percent change, is at almost 9% year over year, which is essentially at the high end of the range that we have seen over the past, 10 years plus. So you can see that if you were to draw a trend line here, current factory orders are basically at long-term trend, maybe slightly above long-term trend. We can see that the year-over-year number, which is the chart below it, is roughly at 9% here, year over year. So again, very strong growth on the demand side of the equation here. So essentially, we've recovered the entire, pandemic drop and then some. We're basically back at long-term trend. So again, that's very encouraging to see because a declining backlog is good to see, but if it's coming because of softening demand, that to me that's an indication of slowing economic fundamentals and ultimately recession, right? But we haven't seen that with factory orders, and we haven't seen that with durable goods orders either. You can see on the next slide here. Other leading economic indicators remain strong. However, I will note that the breadth is declining. So among various different economic indicators, I believe there's 8 to 10 of them in total. They still remain strong, but the number of leading economic indicators that are remaining strong is decreasing. So therefore, the overall index, if you will, the leading economic indicators index, has started to show some weakening here. But as I was mentioning just earlier, factory orders remain strong. Manufacturing durable goods orders remain, very, very strong here at roughly 4.5% year-over-year growth, which again is near the high end of the range. That's kind of where it always has been on a year-over-year growth basis. You can see that the spread on the 10s and 1s from the Treasury side of the equation, that number is starting to come down a little bit. So we're going to take a look at that a little bit more in detail in a few minutes here. But initial claims is yet another forward-looking economic indicator. And, it's upticked a little bit here, but it's not much to register anything of concern just yet. So we just got the jobs number just last Friday, and that beat expectations. So far, the job market remains quite strong. And initial unemployment claims remains very, very subdued here. So, this to me, the broader picture is telling me that, again, recession is a little bit early to be calling, but, the breadth of the leading economic indicators has been declining. So it's something to keep an eye on, but I still do believe that it's too early to be calling a recession at this point in time, based on this data that we're seeing here. However, we can see that the Chicago PMI did come in a little bit soft here. They registered actually at 54 in the most recent reading here. I put up this chart here, which is again another thing that you don't often see cited in financial media, but the Chicago PMI actually has a very strong leading correlation to S&P 500 earnings growth over time. So you can see here that it bottoms out in advance of the earnings bottoming out. It tops out in advance of earnings topping out. So I think that now that Chicago PMI has really kind of rolled over a bit here, but it's still expansionary. It's still well above 50. It's still nothing of major concern just yet. But I do expect the S&P 500 earnings growth year over year to decline. But that was pretty much expected because this was a very high watermark year. In terms of last year's earnings growth over the prior year because of the deep base that trough in earnings due to the COVID disruption of 2020. So obviously the comps were very, very high. So therefore you'd really expect earnings growth to come down quite a bit here. So this is obviously telling us that S&P 500 earnings are expected to come down in terms of the growth rate year over year. But it's not yet concerning to me because it's still above 50. It still means that manufacturing activity in the Rust Belt is expanding still. So it's not yet flashing recession, but it's something to keep an eye on because that number is slowing. So if it does drop below 50, that would start to get a little bit concerning here. But again, there have been times where even if Chicago PMI drops well below 50, we saw that happen in 2014, 2015 here, dropped all the way down to 43 at one point. And it remained under 50 for quite a while. So that was a false call in terms of calling a recession, right? So that's not necessarily the end of the world for that to happen, but it does have a very high correlation with S&P earnings growth, as we saw here. So even when the Chicago PMI got that low in 2015, earnings followed, and you can see that earnings actually declined year over year by roughly 2% a year. So that could follow, right? So, but that may not be necessarily the end of the world in terms of recession. The markets didn't necessarily just roll over and die that year, right? We actually ended up rebounding quite swiftly and had one of the best years ever in 2017 with a very, very strong bull market that year, with very, very little volatility as well in the market. So Chicago PMI has a very, very high correlation. I'd love to keep an eye on that. But, this is just one input among many that we should be watching very closely here. Another reason why I think that inflation may have topped out, right, is the fiscal deficit. And this is another thing that also doesn't get enough press time that I think it should. Right now in 2022, the deficit thus far, through May of this year, 2022, is among the lowest, over the past several years, really going back to 2017. You can see in the dark black line right here, this is the current year deficit thus far, cumulatively speaking. And we're basically tracking very, very low, essentially a 5-year low in terms of how big of a deficit that the U.S. government is running here. So this is the lowest deficit in the last 5 years, and it's a far cry from where we were in 2020 and 2021. Remember, those 2 years, we ran roughly a $3 trillion deficit, almost, both of those years. In 2020, it was roughly $3 trillion. In 2021, it was roughly, I think it was about $2.7 trillion. So those were very, very nasty years with regards to how much debt that the U.S. government racked on by running this massive deficit here. But so far this year, it's been very subdued. And the CBO, the Congressional Budget Office, now projects roughly a $1.15 trillion deficit when it comes to fiscal year 2022 by the time we get to September. So again, that's a very, very tame deficit, and that is also disinflationary because the deficit to GDP ratio has come down quite a bit versus where we were just a year or two ago. So that's very good for the finances of the government, but also it is disinflationary relative to where we were in the past. So that's something to also keep an eye on as well. And again, I want to give credit and cite the Peterson Foundation for putting this chart together. But I think this is very noteworthy here to keep an eye on as well. So a lot of good things, but the bond and commodities markets may be sniffing a recession. So we look at the Treasury yield spreads, right? This is the 10s to 30s spread. And again, this is the age-old, indicator of recession, which is when these numbers really invert, meaning the yield on the 30-year drops below the yield on the 10-year. That is a forward-looking indicator of a recession. We saw that happen right before the Great Recession of 2008. We saw that right before the dot-com bust in 2000. We saw that back in 1989, right before the 1991 recession. So it's had a pretty strong track record of predicting recessions. And so this entire development here has been quite concerning. It's still above zero, so not yet, giving an ultimatum just yet, but the trend is definitely down. And if you look at other yield spreads, such as the 10s versus 2s, that number has actually inverted now. If you look at it as of July 6th, this number has inverted. So this is the spread between the 10-year and the 2-year Treasury. This number is officially fallen below zero. So this is noteworthy. I think very, very, concerning that this is indicating a recession is on the horizon. And this could be one of the reasons why commodities prices have actually sold off quite a bit here, with oil prices backing up significantly, with wheat and oats prices backing up quite significantly. The bond market and commodities markets might be telling us that a recession is on the horizon. And, most times a recession is the ultimate antidote to inflation. And so with an inverted yield curve here, at least on the 2s and 10s spread, and soon to be perhaps on the 10s and 1s or the 30s and 10s, this is definitely saying that something is up, and economic growth may not be that we've seen in the past may not be happening going into the future. So the bond market is definitely telling us this. Also, if you look at TIPS, right, versus nominal 10-year treasuries, they've both had a deep bear market, right? We've had 40-year high in inflation, but TIPS have really not done well at all, right? Usually TIPS are supposed to provide inflation protection. So the way that these TIPS work is that the face value of the bond is indexed to the CPI, right? But it is a market after all. So despite the fact that the CPI has surged, to 40-year highs, the price action of TIPS has actually been quite bearish, and it's essentially tracked, the return of just nominal 10-year treasuries, which means that, despite the inflation that we have seen, the bond market is really saying that, look, this is transitory. I know that's been laughed at, but the bond market is telling us that, look, this is not going to last for very long. Because if it were here to stay, then TIPS would be performing much, much better than they have. And yet TIPS are down year to date by 11%, which is roughly in line with where the nominal 10-year Treasury yield has done, or 10-year Treasury bonds have done. So again, TIPS are basically telegraphing that they don't believe that this very, very high CPI is here to stay. Unless if something changes quite dramatically here, and TIPS suddenly turn back up, I don't think that this is telling us that, the CPI will be here, a high CPI is here to stay for very long. Let's turn our attention a little bit now towards the equity markets and, how have, stocks, digested all this information. And stocks have reacted quite dramatically here. We can see forward PE multiples for the S&P has compressed to 25-year averages. We're down to about 16 and a half times forward earnings. That really kind of compares exactly in line with the median. If you look at the table at the bottom here, the median forward PE multiple on the S&P 500 has been roughly 16 and a half. That's exactly where we are today over this past 25-year time period. So we are way back to historical averages on PE multiples, and it's really accelerated this year alone. So it's been very, very quick to reflect these changing fundamentals here. And if you look at it on a price to free cash flow basis, we're well below the 25-year median. The S&P now is trading at 24 and a half times free cash flow, which is well below the median of almost 30 times free cash flow. Now, again, a lot of that is distorted by the incredible bubble that we lived through in 2000, 2001. But this is again another indication that look, stocks are not that expensive. A lot of people are drawing comparisons between today's market and the one that we went through in 2000, 1999. Based on these numbers here, especially based on free cash flow, which is the ultimate measure of profitability, we're nowhere near those multiples that we saw back then. So companies have gotten very, very efficient, very lean, as we'll see in the next couple of charts here. But on a multiple of free cash flow, the S&P 500 is well below the 25-year median. The similar situation with the Nasdaq. That's the epicenter of this bear market that we've been through right now. And Nasdaq is trading at 23 and a half times free cash flow, which again is also well below the median value over the past 25 years, or roughly 29 times. So the Nasdaq, when a lot of people are talking about bubble markets, they typically are talking about growth stocks, and the Nasdaq is basically, the epicenter of, the growth equity world. We're nowhere near the bubble highs of 2000, 1999, 2000. We're not even near the multiples that we saw just before the great financial crisis of 2008. We're well below that number here. So, again, could this number continue to compress? Sure, right? But, to draw the comparison between today's numbers and 1999 is quite a stretch. Maybe that's the case in certain isolated areas of the market, of, some of these SPACs and other cash burning companies. Maybe those companies are still trading at bubble multiples, but the NASDAQ 100 is not, trading at 23 times. Now, can that come down? Sure. I mean, we got, quite low here, well below the, 20 times roughly. We can get to 18 times maybe. That could certainly happen. So that, that could represent another 20% downside. That could certainly happen. I'm not saying it can't. But in terms of multiples, we're not anywhere close to where we were in those times. Now, downward estimate revisions have started for the NASDAQ. However, it's mostly flat over the past year, so it's not anything of concern just yet. You can see that the estimate revision has come down just a tad bit, right? From May of this year, it was at $5.83. It's been revised down to $5.77. That's the bottom-up weighted average of the QQQ. And it's really basically flat over the past year, down just roughly 0.9%, and down about 1% for next year. So again, estimate revisions may have started, month over month, but over the past year, it's not anything noticeable just yet for the NASDAQ. So maybe we'll see estimate revisions come down or start to accelerate to the downside, but we haven't seen that just yet. And this is partially due to the fact that, the S&P X financials and energy, this is the Zacks standard industrial proxy. This is taking the S&P 500 and removing financials and energy so that we get a true proxy of industrial companies. And this is their free cash flow margins. And check out this chart here. Companies today are essentially the most lean and the most efficient they have ever been in 25 plus years. These companies right now, this again, S&P 500 X financials and energy, they are now roughly generating 10% free cash flow margin. So for every dollar of revenue, they're translating that to 10 cents of free cash flow, which is phenomenal. And essentially at an all-time high, roughly, almost. We hit highs of almost 12% right at the start of 2021. That has come down, but again, still very, very high at 10.4%. So, and this is also happening while balance sheets are very, very strong. They've been just about as strong as they ever have been. Again, for the industrial companies here, leverage ratios are basically at the low end of the range. This is net debt to EBITDA. So balance sheets are very strong relative to income, right? As as measured by EBITDA. So these companies are not very highly levered right now. So whatever issues we do, face, if we do get a recession, it won't be because of credit risk, in my opinion. And the reason is because of this chart right here. Balance sheets are quite strong, and net debt relative to EBITDA is at the low end of the range. So even if we do get negative estimate revisions, we've got a lot of slack to go before we really get to the dangerously high levels that we saw in these prior periods here. So again, that's very bullish to see overall. And finally, shares outstanding is basically a fraction of where it was 5-10 years ago even. So you can see that the slope of this chart here is roughly negative 5.2%. So shares outstanding for the S&P 500 have reduced by roughly 5% per annum over the past 20 years or so. So that again puts a floor in where the market will ultimately bottom out. So again, let's put all of this together. What does all of this really mean, right? What it means is that backlog has notably eased, right, while factory and durable goods orders remain strong. So this really suggests that supply chains, the chokehold on supply chains might finally be easing. Still early to tell, but it looks like that is where things are headed right now. The backlog is decreasing while demand remains strong. The only way that can happen is if production is starting to come back up and supply chain bottlenecks are starting to be resolved. That's very, very good to see. On top of that, the budget deficit has been reduced to the lowest level in years. Core CPI has been ticking lower even as headline CPI hits all-time highs. So really the combination of all three of these things together is disinflationary. So I do think that headline CPI should start to come down because of all of these factors here. Now, on the opposite side of the spectrum, we have a very strong dollar and weakening Chicago PMI. So this means that there may be downward estimate revisions for the S&P 500 coming. Now, we also have, as we saw, inverted yield curve on 10s and 2s. That is suggesting that there could be a recession on the horizon. However, corporate balance sheets are strong, lowest leverage ratios in decades, very strong net margins and very strong, cash flow margins. So again, there's a number of very bullish indicators and a couple of bearish indicators, right? So we are seeing strong, numbers on some of these economic indicators. But the bond markets are signaling something is happening, something is brewing. So, the core numbers may look strong right now, but the bond market is possibly saying that, these numbers may start to head south. So they haven't headed south just yet in terms of overall numbers, like the Chicago PMI, the, factory orders, durable goods orders, initial claims. All of these numbers that are leading indicators of economic activity are strong, but the bond market is saying something different. So I think we need to keep an eye on that and see where that goes. But again, corporate balance sheets remain strong, cash flow margins remain very, very strong, But ultimately, what the most important thing is that we all have to keep in mind is what is the market pricing in already, right? The market has already been in a bear market. The S&P is down roughly 20%. The NASDAQ is down roughly 30%, right, from top to bottom. This means that there's already been substantial forward P and price to free cash flow compression. And as we saw in the prior slides here, they're already down to 25-year medians or lower. So this, to me, suggests that the buy side, right, the investment community, has already started to price in a recession and an earnings contraction, even as sell-side analysts have yet to pick up on EPS estimate cuts, right? So we haven't seen sell-side analysts just yet slash their estimates by noticeable amounts just yet for the S&P 500. But because we've already been in a bear market, I think the buy side has already priced in a mild recession. I think, my personal opinion, this is just an opinion of mine, but my hunch is because of all of this data that I'm seeing here, I think the market has already priced in roughly a 10% earnings drop year over year from 2021 to 2022, or, 4 quarter on a rolling 4 quarters basis. So the next 4 quarters over the prior 4 quarters. So I think a 10% drop on earnings is already priced in. So the key is how bad does it actually get versus this baseline expectation, right? So we always need to measure the actuals versus the expectation. And because, we've had this, very, very noticeable contraction in PE multiples and price to free cash flow multiples, I think some earnings contraction is already priced in. And that number for me is 10%. Maybe it could be 5%. So anything greater than 5% might lead to further downside in the market. But I think that number is roughly 10% based on just, a combination of, a 20% drop, which means that a 10% earnings drop is factored in, plus another 10%, multiple, compression, which inevitably happens during every bear market. So 10% is my estimation as to what is already priced in. And I think that the Fed really should not be raising the Fed funds rate any further. This is kind of controversial because CPI is still very high, so it could be a little too early to be pausing Fed funds rate hikes, but I think they should stop. I think they've hiked enough, and I think there's enough to show that supply chains may be finally easing based on those numbers that we saw, based on the the declining backlog, and based on the fact that core CPI and core PCE, which is, by the way, the Fed's preferred measure of inflation, that has paused now for several months. And now that we're seeing declining, commodities prices in both food and energy, I think that there is a case to be made that, the top is in for inflation, for the CPI. And on top of that, we are already seeing that the Treasury yield spreads are inverting. The bond market thinks that there might be a recession coming. PE multiples have already contracted. The buy side thinks that there's a recession coming. I think the Fed should take a pause and see what happens here. They probably won't. I think they'll probably still go another 50 to 75 basis points for the July meeting, but I think they really shouldn't. And that, I think, in my view, risks the policy error. Because we're already seeing the bond market, invert the yield curve. So I think a little bit too much aggression by the Fed may be a catalyst for an increase, for a accelerating recession. So that is my personal opinion on what has happened already. So a 10% earnings contraction is already in the cards. And I think the Fed should not, hike rates much further than what we already have seen. But we will see what that happens in a future, webinar that we put together here. So what happens in the next couple of meetings will be very, very critical. I will definitely do an update to this presentation next month after we get the commentary from the Fed decision during their July meeting, and another month of inflation data. Should very, very much give us a strong indication as to where we could be headed over the next 6 to 12 months. So hopefully you found all this information helpful. I'd love to hear any feedback you have. If you have any other questions or if you'd like me to focus on any other topics of interest, I'd love to hear from you. If you are a ZRS client, please email us at zrs@zacks.com. And if you're an Advisor Tools client, please send us an email at zat@zacks.com. Thanks, everyone, and hope to see you again in a future webinar from here. Take care.